All right, everybody. So we're starting to see a little bit of divergence set up between some of the US market indices. Let me very quickly explain this to you. Here is the chart of the Dow Jones Industrial Average. If I go up to the weekly time frame, you can see that we are closing down very close to 300 points. We are left with, as at the close on Thursday, an inside weekly type of candlestick. We have in the past spoken about the possibility of the market actually pulling on back down to close this open window that we established between Friday the 29th of March and also the first trading session in the current month that we find ourselves in. At the moment, we're doing everything that we can to actually hold above that gap support. You can see we've come on back down really this week since Tuesday, then of course on Wednesday and again today to actually retest that old support, or at least the beginning of that support, as consecutive days of support. And as at the current juncture, we're still technically holding it. However, it's not looking all that good. There are a few pieces of analysis though that are working in the favor of higher prices, albeit temporarily, before we do see that of a deeper correction. So technically speaking, if we were to see the market, that being the industrial average, pull on down to roughly 26,000 or a little bit lower than 26,000, again, just over really 125 points from where we closed at today, it could still take the formation of a bull flag continuation. And the reason I say that is because when I bring up the exponential moving averages, if my charting software wants to work with me, you can see that we are once again retracing and pulling back on into both the rising 10 exponential moving average and also to a lesser extent at this time that rising 20-day exponential moving average. Now again, that is essentially the setup, or at least what you should be paying attention to, technically speaking, on the actual Dow Jones Industrial Average. Where it becomes a little bit interesting is that when you consider that of the past price action, at least over the past 4 sessions this week, the NASDAQ itself, if I bring up the weekly time frame, it's really immaterial in the actual movement over the past 4 sessions. We haven't seen that type of percentage retracement that has gone on in the Dow Jones Industrial Average, and we are rather unchanged. We're getting very close on up into that magnet, and the reason I call it a magnet is because of that psychological round number coming in at roughly 8,000 or exactly on 8,000 on the NASDAQ. We have our target up here at 7,998. We're down here at roughly 7,938. But again, even to a lesser extent, if my charting software wants to work with me once again, when I bring up the exponential moving averages, you can see that we haven't actually interacted yet on either that of the rising 10 or the 20 days. So again, we're sort of marking time at the moment. The market itself is moving sideways. What we don't have is that of a bull flag setting up on the NASDAQ. It does look more so like sort of a stair-step type of pattern. However, what I'm not really expecting at this time is to see any real major sort of material follow through to the upside. It really looks as though when we consider the oscillators and just how stretched they are across the board collectively, it makes a lot of sense that this resistance area up here, more or less where we are very close to actually trading at the moment, is going to hold. It should, hold temporarily, which is going to encourage, again, these oscillators to reset, which is also going to encourage price to pull on back down. However, don't find yourself buying into, of course, the bearish macro backdrop. A lot of people are picking up and beginning to say or have said that this is some form of a long sort of triple top under formation or an inverse, sorry, not an inverse, but a head and shoulders pattern with the left shoulder dating all the way back to pretty much late 2017. The head being in July, August, September of 18, and then, of course, currently the right shoulder under construction. I couldn't disagree more. At the moment, any pullback, again, depending on how deep it is, we are going to treat it as a buy the dip opportunity. In the meantime, really, you should somewhat pull back or refrain from actually adding additional risk, okay, taking on additional positions until we either come up into this resistance area and then we can sort of set up a bidirectional trade setup, right, for the breakout or the breakdown. Or what you should be doing is highlighting support areas as to where you will jump on in to buy the bounce. One of these two things is going to happen, all right? I think the one with the lesser probability is that we're simply just going to break out immediately. What you should be more so prepared for, at least mentally prepared, is for a correction, all right, or another little pullback. I'm not talking about a 20% drop in the market or equity prices whatsoever. It's more so to come on back down and to at least close those open windows. But generally what happens is we do overshoot them, albeit temporarily, before the market itself stabilizes. So I would suggest at the moment too, if I can bring back on up my exponential moving average template, is that you should be thinking about the rising 50-day exponential moving average, which is coincidentally coming in at this most recent swing low over here again, painting a picture of a series of higher lows. However, again, going back to late March, this is the low that you'd want to be focusing on if you do see that reversal up here from these current prices. Now, when it comes, apart from that, everybody, the market itself has been relatively sleepy. If I show you the S&P 500, it really sums it up quite well once again. We are slightly net negative on the week. However, largely we've gone absolutely nowhere. So it's been a little bit of a snooze fest. However, I do see storm clouds, or at least a little bit of turbulence in the foreseeable future across the board on the US market equities, whereby we see some pretty large gains followed by some pretty large sell-offs, so equally, if not as large or more large sell-offs. And then, of course, we're going to see the pops again. The net sort of movement overall, though, the aggregate is going to be rather immaterial. So just be aware of that. It shouldn't be all that conducive, unfortunately, for jumping into swing trades. At the moment, we've got a lot of open trades on, and it's more so moving into the management of those trades, okay? And as such, just to really surmise this, you should be thinking about, again, refraining from adding additional risk, allowing the market to actually settle, and then entering when you feel more comfortable, or unless you get a truly technical, right, signal, whether it's through, the perspective of candlesticks off from those rising exponential moving averages, or it could be, of course, the gap fill that I've already spoken about in this very brief market update, or ultimately be a break and a continuation above the resistance, but also giving it some additional room, what we call fluff, to continue above to really mitigate that of a whipsaw if the market does push up into that resistance area as well. So again, markets have been a little bit sleepy this week, understandable. However, prepare for turbulence if it does arise. I don't want you to be surprised for it, or when it does show up. Instead, you should embrace it at certain levels and understand that these markets collectively are poised to move higher further into 2019. All right, so that's going to do us as at the close on Thursday. I will see you all in that pro analysis class on Saturday. And we'll see. I might do another public YouTube video over the weekend. All the best, everyone. It's James signing off on behalf of Pivot Point Trading. Goodbye.